Now we're going to look at the entire stock market if it is somehow out of whack with the rest of the economy. This is GDP, so this is the size of the economy, and then this is stock market capitalization. The stock market has no business being bigger than the US economy. This is like crazy levels when that happens. And this is the third time this century that the stock market is larger than the economy. And this brings us to something called the Buffett indicator. Warren Buffett is the world's most famous investor. He's one of the most successful investors in history. He became the world's second richest man simply from investing. And one of the things that he says is the best indicator of whether stocks are overvalued or undervalued is how big the stock market capitalization is compared to GDP. So if you take the last two lines, GDP and stock market capitalization, and you divide them by each other, you end up with the percentage that the stock market is of the size of the economy. And you can sort of see that somewhere between 50 and 70%, this range right in the middle, things are in balance. The stock market is not out of whack with the economy. But once it gets over like 90% or so, this gets to be a danger level. And it has no business being over this 100% level. That's really crazy. You can see the dot-com tech bubble, the global financial crisis, and the Lehman Brothers meltdown. And you know, this peaked at almost 160, it was 60% larger than the economy. Right now, the stock market is 40% larger than the economy. Now, I'm going to come back to this indicator later, because that shows that we've seen that all of the individual stocks are overvalued and in a bubble. Now we've seen that the stock market is sort of top-heavy compared to the rest of the economy. It's out of whack. Now we're going to take a look at margin debt. Margin is leverage in the stock market. You open up a trading account. If you qualify for a margin trading account, your brokerage house will let you borrow. So you put 20% down and you can buy 5 times more stock than you can afford. And that gives you a 5-to-1 leverage. And if the stock goes up 10%, you make 50%. But if the stock goes down 10%, you lose 50%. So this leverage makes investors very nervous, and they tend to have their finger hovering over the sell button. And all of the black box trading that's done by all of, they call them proprietary desks at all of the brokerage firms, where they're doing their own trading. These programs are, they've got certain scenarios where they trigger a bunch of selling. And margin debt is currently at the highest levels in history. And there's a couple of ways of looking at that as far as how out of balance it is with the economy. When you look at margin debt divided by the GDP, that's currently at the highest level in history. But I came up with something new. I wanted to know, how big is the margin debt compared to the size of the stock market? Well, the margin debt divided by stock market capitalization isn't the highest in history. The highest in history was right here just before Lehman Brothers went under, just before the financial crisis. Lehman Brothers was leveraged at 30-to-1. That means they only had to put 3% down, but if their investments went backwards by just 3.3%, they were wiped out. And that's exactly what happened. They went belly up, and it caused a global financial meltdown. You can see here that it's sort of in balance when it's about 1% of the stock market, and that it's done this climb, and we're at about 2.1% right now. Now, 2.1%, that doesn't sound like much, but remember that a bunch of these big banks today, they have 20 times leverage. The average investor can get 5 times, but the big brokerage houses, they get to do 20 times leverage. So this 2% could represent, if it was all brokerage houses, that could represent 40% of the stock market. Now, what I did as an indicator to show the fragility of the stock market, we've seen that individual stocks are in a bubble. We've seen that the stock market is sort of top-heavy, that it's out of whack with the rest of the economy. The margin debt is like cracks in the foundation. And so I took the Buffett indicator, I told you before that fair value, undervalued is when it's lower than 50%, and fair value is like 50 to 70%. You can see that band going across there. Overvalued, bubble territory, and hyperbubble. And it's in that hyperbubble territory. But now I'm going to adjust this for margin debt to create something I call the fragility index. So this is Market Fragility Index. We don't need the scale anymore because it really doesn't mean anything. But the shaded areas do mean something. This one is nothing to worry about. There's no threat. This is normal. This is time to worry. This is unstable. This is super fragile. And this is threat to the global financial system. Each time it got up into this area before, we've seen just amazing crises where there's these emergency meetings and they have to do bailouts and things like that. And so we're back up into this territory again. This is the Hussman indicator. I'm nearing the end of the everything bubble presentation.